welcome to my entire trading strategy. And by the way, you don't have to trade like this, but just understanding these concepts will help your trading significantly. I don't care if you pattern trade like flags or breakouts or CISD, MACD, RSI, whatever that your strategy is, support resistance, bull flags, bear flags, ICT, non ICT, I don't care what it is. It's all relevant because I'm breaking down how the market moves. And if you can just conceptually understand it, then you can build the same logic around your personal trading strategy. But in this YouTube video that I'm breaking down into parts, in this series, I'm going to break down my strategy. And at the end of everything, we'll go into a backtesting session and I'll do top down analysis and we'll combine everything you learn from this video so you can bring this to your trading. So, what we're actually going to be learning is understanding time and why it matters because it's always time and then price. But I like to add logic, time, and then price because if you cannot create a narrative around the time for the price to deliver, then you're not going to be consistent and you're going to get screwed and you're going to get frustrated, overtrade, etc., etc. We're going to understand market structure correctly. So you have higher highs, higher lows, but then internally, that's what I'm going to teach you guys of how the market actually looks like on the lower time frames. And a lot of people don't go into detail about this. And so this is really going to help you stay out of the consolidation and start to getting on side with the expansion. So that's going to help a lot. Understanding draw on liquidity, DOL, right? A lot of this is abbreviation, but on the slides I do write them out. So draw on liquidity, this is vital. If you don't understand, again, these are ICT concepts, but you can take this with your support and resistance. You can take this with your indicator strategy, whatever it is. I don't care, like I said. Um, but again, at the end, we're going to go through and do my strategy because that's how I trade. But understand draw liquidity. If you don't know where the market's going, then there's no trade. Okay, so if you're confused, if you look at the charts and like you just don't know what's going on, or you cannot create a narrative, the if then logic, then you don't trade. Because what I always say, and I get this from a really good friend of mine who's a 7-figure trader himself, plan the trade, trade the plan. And if you can't understand where price wants to head based off the draw, then you don't trade. We're going to understand standard deviation slash premium and discount. So this is the Fibonacci uh, tool, and we're going to go into detail why standard deviation works and how it's a mathematical calculation of the mean of the average price. So if price is in a consolidation, we are creating the average. And then once we get a standard deviation away from the average, that's how we can frame either a pullback reversal or potentially a consolidation. So this is going to help with taking profits and or starting to look for a reversal to continue higher if you're trading with the trend. Premium and discount, again, we want to buy when price is low, sell when it's high. Again, we'll talk about that in detail. Weekly profiles. This is, if there's one takeaway, it would be weekly profiles and IPDA slash market profiles. They're a little bit different, and those 5 through 7, 5 through 8 really, um, well, and it's just all of this is such good stuff, where I need you to pay attention because if you don't understand draw and you start studying weekly profiles, then you're just again, it all stems from the draw and liquidity, which is based off time and some other. stuff. But anyways, weekly profiles, that's going to help you a lot with understanding if Wednesday or does something, then we can anticipate Thursday being a continuation, right? So it'll keep you on the right side of the market and just execute with more confidence. IPDA, this concept right here, again, these are all ICT. Use it with your strategy, or you can try my strategy. But IPDA pretty much is we cannot reverse from consolidation. We like we're in a price delivery mode because price is delivering to an objective through IPDA, and we'll talk about that more in detail. Understanding continuation market profiles slash reversals. This is really good. So V-shaped recoveries is what a lot of people say. When we consolidate below the drawn liquidity, any lower move is manipulation, right? Before we get that expansion higher. And that correlates to the if then logic. So if price is consolidating, then we can anticipate a manipulation or straight expansion. Okay. So a price cannot reverse from consolidation. It has to manipulate, whether that be an SMT or straight up price just goes higher than goes lower, right? Sweeps a high per se. And then how to create an if then logic to frame a true bias and create a plan for the day. This is pretty much top down analysis. So if price taps into a PD array, then we can anticipate based off of, higher draws and some other stuff that we'll go into. But just that if then logic will help, right? Help you not overtrade and stuff. We'll go over the entry model aligned with time frame alignment. So time frame alignment again is essential. It'll make sure you're not too sucked into the time frames, and we use all of them. Risk management and how to actually trade. What I mean by this more specifically is trading is just probabilities. Your goal is to just develop an edge that over a long series of trades or a lot of trades you come up profitable. So it's not about being right or wrong on a daily basis. It's about being right over a long basis, but with risk management. And then, of course, we'll put everything together. So this is going to be part one. We're going to dive into time and why it matters, market structure, and then the draw on liquidity. And then part two, we'll do standard deviation, weekly profiles, and IPDA. And then part three, we'll do 7 through 9. And then 10, 11, and then 12 will be I'll hop on TradingView and we will go through all of this together. And maybe the last episode we'll do a back testing session and I'll do a random date generator so it's not pre-studied or whatever. We'll start it from the top and do everything. So without further ado, let's get into it. So I want you to look at this chart, and this is the 15-minute time frame, by the way. That's the only context I'll give you, but I want you to look at this and what do you see? Okay? Because at the end of the video or the end of this presentation, we're going to go through this exact chart and you'll see hopefully the market a little bit different. Okay? So, are you bullish or bearish? Where do you think price is going? Try to predict what you think price will do in your head. So from where it's at, is it going to go higher and then go lower? Is it going to go lower then higher? Is it going to go sideways? Where do you think it's going? What do you think it's going to do? Draw this out in your journal, okay? Because then I want you to reflect on this towards the end on part 3. And again, I'm going to use this example at the end, and then I'll compare it to this, and I want to see where you're at. So, understanding time and why it matters. So time and then price, that's what I explained earlier. But the logical framework we evolve our entire theory of how and where price will go is based off of time, not market structure. So what I mean by this is the market will deliver at a specific time of day. Okay. The market will manipulate at a specific time. If the market structure is bullish, say not at a key time, but then at a key time we just rip lower and then we close, right? Now we're creating bearish market structure. But that was just manipulation to head higher, right? And that's what I mean by it's not about the market structure, it's about the time of when that down close candle appeared, okay? And then what that's ultimately doing to the left, right? Is it sweeping liquidity at a key time, making it look like bearish market structure, but then we just go bullish. And that's where a lot of people get screwed up, is because they're not paying attention to time. So if time does not align with the market structure of what the market structure is suggesting, then we do not look for a trade. So if it's like 12 o'clock, right, and we want a key level to get swept before we head to the objective, if it's happening at 12 New York time in the morning, then we don't anticipate that to be the manipulation. So we can see continuation lower until a key time presents itself to then reverse. Okay, that's kind of an example, if you can visualize that in your head, is like we want a key time to manipulate into a level. Why time matters, I kind of just explained it, but price will manipulate into a key level at a key time. Knowing and understanding that price will manipulate during key time is what allows us to frame an if then logic sequence that then we will use to start planning the trade. Remember, plan the trade, trade the plan. So let me give you an example. If we have a fair value gap under us and we're consolidating, we would want 930 to open low into the fair value gap, displacing higher, because that's a key time to manipulate the swing low. And then if we get the CISD, the change in state of delivery from bearish to bullish, then we can anticipate price to continue higher if there's a clear drawn liquidity above us, or a clear target, a clear resistance, or clear what again, however you use the lingo in your strategy, whatever the target is, right? So at a key time, price open low, or the market open low at a key time in a PDA, so a key level, and then headed higher. So that's a key time in a key PDA to the draw. The times of manipulation: 2 to 4 a.m., 8 to 11 a.m., 2 to 4 p.m. So more than likely you'll see one of these being the low or high of day. Okay, so the 2 to 4 a.m., that's London session. You'll most likely see 2 or 3 a.m. will be manipulation for London. And then 9 or 10 usually, 8, 9, and 10 will usually be the high or low of day. And then 2 to 4, that's like market, power hour, market close. So that's when larger traders, institutions, and such are offloading positions. So you might see it could rally or it could just go sideways. 2 to 4 p.m., not my favorite, to be honest. I like 10 a.m., 3 to 2 to, I like London's 2 to 3 a.m., and then I like 9 to 10 a.m. for my key highs and lows. But it doesn't really matter too much on like your favorite time. It's just that's when you'll want to, if you're gonna get into a trade, consider like, could this be the lower high of day, right? And I'll show you examples of that right here. This is the hourly chart, and this is just a few examples. You can see the high and low of day is at those key times. Okay, so kind of how you would use this is compare. You would want to use this with weekly profiles and like what price is sweeping into at a key time. So, for example, this right here, If we have a clear drawn liquidity, let's just say it was this high, right? If I draw a line with my mouse, you can see, right? And price opens low, 930 manipulates lower into this fair value gap right here, right? And if we draw a range here, this is discount of the range. And then we can see 1030 opens uh, high, low, close, and then we get the displacement higher hitting this drawn liquidity. So 10 a.m. was the key time tapping into the key level at a key time, right? And we have it in our bias was bullish. So even though we did market structure shift here or CISD or whatever lingo you want to use again, if we anticipate higher prices, this is a low at a key time, right? So we'll go on to market structure. Right here, the black line is the daily trend, and then internally, the blue line is the hourly. And this is fractal, so this could be the black line could be the hourly chart, and the internal could be the 5 minute, right? So it doesn't really matter, but the more advanced market structure, understanding the blue line is what will keep you on sides with the market. You can see how like price is sweeping, then displacing higher, creating that higher high, but on the bigger time frame, but on the smaller time frame, these pullbacks, right? Understanding that you're trading the pullbacks, right? So high, we displace low, sweeping liquidity to the left, making a CISD fair value gap tap to continue lower, but then we leave this low because maybe we create an SMT. Maybe we just tap into an order block because the draw is somewhere higher, but then you're like targeting for like the lows way down here, but not understanding on the higher time frame, you're just trading the pullback to continue higher. So understanding where you're at in the market is going to be what allows you to take, the 1 to 2 R or the 1 to 1 or cutting your risk in half if you're trading the pullback, knowing you're trading the pullback. And then vice versa, right? If you're only looking for longs, just because we get a CISD here, and if we don't close below this swing low down here, because this is the higher time frame, higher high, if we close below it, then yeah, we could be bearish, right? But if we know we're starting to respect bullish PDRAs that are in discount, then okay, now we can start looking for the reversal, but it's also the continuation on the higher time frame, and that's where you can start leaving runners. But on retrace, you don't want to do that because obviously it's just going to get stopped out. So understanding that concept right here, it might be an aha moment for you right now. It's like, oh my goodness, that's probably why I keep getting screwed up, because every CISD you see on the hourly has you all messed up because you're not keeping in mind the higher time frame. And that's why I labeled this as understanding the market structure correctly, because we have the bigger higher highs, higher lows with higher lows, lower highs internally, but that's just the pullback. So I have this chart here and I want you to mark this out. So you can either pause the video here, take a screenshot, and annotate on top of it, or you can just kind of visually annotate it yourself. And the next slide, I annotated it to show you what I see. I'm going to be teaching you, but obviously this is hindsight, so like in the moment it wouldn't look like this, obviously. But how do you visualize this market? Yeah, I'm going to give you a minute here to just look at it, and then I'll click forward. So pause the video, and then I'll click forward here in a second. This is the way that I saw the market. Okay, I'm going to show you real charts here as well, but I just have line schematics because it's easier to read. So we have accumulation, manipulation, distribution. Now, I guess I didn't really mark out the key level here, but let's just assume that there's a key level here. Okay. So when price is accumulating, any down move here, we know, especially if it CISDs here, because on the higher time frame, we're bullish. So we know that anything lower is just the pullback. So we can wait for the pullback to happen and then get the continuation higher. So then we play the reversal into the continuation of the trend. So for example, this schematic here could be right here, right, on a lower time frame, like what I'm talking about right here, right? So we take this schematic here and it plays out here. So CISD, fair value gap tap, accumulation, manipulation into the distribution. Do you see that? Accumulation, manipulation into the distribution. At a key time, 3 a.m., swept the lows, displaced higher, New York, open low, 9:30, open low into a key level, right? This could be a fair value gap, inversion fair value gap, the CISD, which is also an order block. So 9:30 opens low, and then internally you get the same um, structure as this, because this is how price reverses, and then you get your entry to wherever. Okay, and then here is another schematic of the entire chart laid out. Yeah, sorry, I was going back and forth to look at it again, but just like what I was just saying, 9:30 opens low into the order block to get that continuation higher. See, notice how it's all the same exact thing. Reversing into a PDA at a key time, sweeping internal liquidity and tapping into internal, which we'll talk about that in a little bit, but creates an IFEG, so displacement met with displacement, or expansion with expansion is a reversal profile, creating an order block or a CISD in this case. You set your limit, stop below the protected low because it's at a key time, etc. And we have a key level up here, so we have a clear drawn liquidity. We get tagged in, price does its thing, and then it delivers. Now, the pullback here, same exact deal here. CISD or an order block with an internal SMT at a key time, low of day, sweeping liquidity inside of a key level, creating expansion met with expansion, reversal profile, creating a CISD in the middle of this leg. Then you can enter the CISD, or you could enter on the inversion, whatever your model. Again, inside of this is a triangle pattern, is a flag pattern, is a bull pattern. All of it, inside of here is a support. Do you notice the support if I draw this line? Right? But this is my entry model, my strategy. So I'm putting in my terms, but I'm just showing you the market structure of how it's sweeping internally to continue higher. Because even though our market structure is shifting, the higher time frame, this is just a pullback. See what I'm saying? And then once we hit our key level, strong displacement. This is the reversal. See how we break this low? After this low breaks this high, but then we displace through after hitting the key level. And then we're going to like chop our way up, creating liquidity. Again, CISD, key time, 2 p.m. reversal, that's the high of day, etc., down to sell side liquidity, which is the original consolidation. So this would be a sell model of the market maker buy and sell model. But yeah, hopefully, so if I go back and now you can see this, and then this is how I see it, and then with further examples, this is how I would see the market. Alrighty, so understanding the drawn liquidity. Okay, so draw dull. Drawn liquidity is one of the most important aspects of trading you need to master. Without drawn liquidity, you'll forever get manipulated, be confused, be on the wrong side of the market, and ultimately fail at trading and quit. So the reason why I say this is because I don't care if you trade support and resistance. Like I said, I don't care about your entry model or your strategy. You're going to always get confused if you think this is a market structure shift without understanding the key level or the drawn liquidity was always this high. Without understanding where price wants to deliver based off probabilities, again, then you're just going to always be confused and you won't be consistent. So the market moves from ERL to IRL, so external liquidity to internal liquidity, back to external and back to internal. Okay, so I'll show you an example, obviously, but knowing and understanding this concept is essential. This is how you will determine your bias for the week and day. Knowing your draw is the backbone to creating your narrative, which we'll use to plan the trade the plan. And external liquidity is swing highs in an uptrend and swing lows in a downtrend. Internal range liquidity is simply fair value gaps. The reason fair value gaps are internal is because they are internal swing highs and lows on the smaller time frame, right? Which creates the low that we want to go and sweep. So, how to find your draw on liquidity? I want you guys to take note of this right here. Okay, so take a screenshot. I'll move my mouse here. All right, so take a screenshot of this and study it or put it up on your sticky note or in your notebook. But your drawn liquidity is going to be weekly highs and lows, previous day highs and lows, session highs and lows, fair value gaps, and order blocks, breaker blocks, any other ICT concept you think of. So like a PD array, right? Session highs and lows, so that's Asia, London, and New York. And we'll go through this right here. So I drew up a bunch of lines of swing highs and lows, and I marked them out. I highlighted them so you can easily see. But see how this is a swing low, and then it gets tapped. Swing low, price reacts off of it, right? Price reacts up to what? Take out these relative equal highs right here, and then we get a reaction. But then the draw is obviously higher. Swing high, tap, relative swing highs here, which this right here, this high here, this high here, and this high here is called low resistance liquidity. And so price is going to do a low resistance liquidity run right here. So it's going to run all of these highs. So this could be your overall objective, while these being your internal, not internal range liquidity, but your smaller like TPs where price could get a reaction. Okay, so look at your charts and you'll see how all the swing lows and highs is where price wants to head. Okay, and I'll explain this more further in trading view of the reasoning for this because of all the stop losses and orders in the market. Okay, so look at this and you'll start to be like, that makes more sense, right? So when people are talking about, I want to see external getting taken, this is what they mean. Okay, so right here we have a fair value gap. Remember we said that fair value gaps are internal range liquidity, okay? So even though the drawn liquidity is this external, because in an uptrend, the swing high is the draw, but in a downtrend, then it'd be the swing low, which I'll show you that example here in a second for a bearish. But price goes from creating a swing high to then creating the swing low, the higher low. So this is going to be a draw on liquidity. Okay, so if we go back to here, this right here is no different than this right here. So we're creating a swing low to then take external, and then price is going to come and take this swing low. When we change from bullish trending to bearish, this will be the target when we're selling. All right, so here is a bearish example. So price is trending down, and if I draw lines out, it's creating all this draw for price to come up and run all these swing failure swing highs. Okay, so then we create a swing low, come up into what? The fair value gap, internal range, because all this is internal liquidity, to then come back and sweep the external range. That's why it's so important to understand draw on liquidity, because if we know based off of logic, and other concepts we'll talk about, expansion met with expansion after sweeping into a PDA to the left to then come out and take out this low resistance liquidity, this being our overall target, this swing high, which is also a fair value gap. Then once we take this, then we can target the external, right? Because this is a downtrend, you're trading the retrace into a continuation lower, right? So that's how we can start framing narrative and logic if we displace higher, creating a CISD right here, the last down close candle that broke, that made the lower low and gets closed above, creates an order block, price opens low, taps the order block, displace higher, making a market structure shift, okay? Because this higher low, right? Higher lows, lower highs for the downtrend, broke this low here, and then we close back above it, so that's a market structure shift to what? Take out this draw. That's our objective from here. Once we take out this draw, we're done. We're done with being bullish because we know we're in overall downtrend. The draw on a higher time frame is lower, and this is a draw on liquidity, right? Because it's a swing low. It's an external. We just took internal. Now we're taking external. So then from up here, we get a CISD right here. The last down close candle before making the higher high gets closed below with displacement, and then the market structure shift here to continue lower. Okay. So here's a schematic I drew, trying to explain this deal here, this low resistance. This is the visual of it. So we create a failure swing, or not a failure swing, but a higher high. Price comes down, failure swing. So this is a draw, right? Because we did not take out the high, so it's a failure swing. Price comes down, sweeps this liquidity inside of a fair value gap that I did not annotate, but we sweep. So we go from external to internal, to then back to external, right? And then we get the higher high, right? On a bigger time frame. See my mouse? Higher high, higher low, higher high, higher low. But internally, higher high, higher low, higher high. Downtrend, but this is just the retracement on the overall uptrend, right? Sorry, that was confusing to say, but on these pullbacks, we're taking on these pullbacks. This is the draw, this is the draw, this is the draw. Internal to external, internal to external. Now, you might be asking yourself, aren't we creating draws on liquidity here? Yes, we are, because these are swings. For when we go from bullish to bearish, we're going to be targeting these external draws. And voila. See how, like, this is literally, and I just drew this randomly, right? But go on your charts and you'll see this happen all the time. And when you can put a lot of time in the charts to understand this, then you're really gonna unlock like a secret power, I guess you could say. Not a secret power, but you'll just have more clarity in the charts. You'll be able to see this a lot easier. We took out external, and let's assume right here this was the actual key level here. So this could have been a weekly draw on liquidity. This could be a monthly PD array that it taps into. Get a strong displacement lower. Expansion met with expansion is a reversal profile. So we expand higher, hit the draw, and then we expand lower. And what do we do here? We close below the lows that broke the high. So we have a market structure shift starting to create the downtrend. This is a head and shoulders pattern, right? Shoulder one, head, shoulder two, right? What else? What other pattern? Consolidation, manipulation into distribution, into mitigating orders, I guess you could say, into distributing lower. This is a market maker sell model, okay? So original consolidation, chop our way up, generating sell side liquidity, draws that I have annotated here, consolidation hits the key level now, and then we create an SMT, some sort of manipulation. Now we can target lower, right? What are our targets? These swing lows, right? In a downtrend, swing lows are the draws on liquidity. And as you can see, price goes down, back up to what? Internal to external. Okay, so these two get ran at the same time because they're relative equal. Back into internal, down to external, come back up, sweep this, back to external, internal to external. That's how the market moves. So if you understand your draws on liquidity and the objective was hit, there's no trade, right? So like if you miss the long here and this external gets hit, unless you want to try and play the pullback, but you get in here, then you get stopped out. So it's really risky. If you don't get in here, if you don't buy the bottom and you buy the top, then, you know, I don't know, for me, it's just like if you're not buying in the fair value gaps, then you're just buying the high, right? Because this is the expansion move we want to get. Consolidation, manipulation, distribution. Consolidation, manipulation, distribution. Consolidation, manipulation, I don't want to say remanipulation, but mitigation and then distribution. And that's how the markets move. And then look what we did again. We created failure swings, creating more draws on liquidity. If the draw is higher, like overall, this is just a big move up into a pullback into a continuation higher. Or hits the objective, and then this could have been the pullback into the continuation lower. So however you, again, the time frame doesn't matter. This could be a minute chart. This could be a daily chart, an hourly. Okay, so this is going to wrap up draws on liquidity, market structure, and time and price and why it matters. And then we'll get into some other stuff as well. So make sure you tune in to part 2, and I'll see you guys later. Adios.